Thank you for joining us today. Let's start with the first session. It's going to be a panel discussion. Dolly, you can also come forward, please. It's going to be a panel discussion. I think most of you hear us speak quite frequently, quite often. So maybe are there any questions up front that you want us to touch that I happy to know about? We're going to touch on the local markets, of course, local markets, what's happening there. The RBSC is going to speak about the elections, local and global. Then we'll definitely throw in the performance as well, how the performance has been looking, and then the commodities, and we have some questions about oil, and then we'll touch currency as well, the rand. I think that's more or less what we wanted to cover. If there's something specifically, we're a very small group, as you can see, you'll just raise your hand or stand on your chair. I don't know if you want to grab our attention, but let's keep it as informal as we can. So I don't think I have to introduce the team. Everybody knows who they are. Let's start off on the global side. We spoke in the market call just last week about everything that's happening in the US. I think it's caught us all a little bit off guard. I think we've always said that America is the greatest country in the world, and Trump kind of succeeded in making it great again, and he might be coming back. But I think we were caught off guard by just how much the US is winning and has been winning since last we spoke. Initially, we had this idea, or well, history has shown us that when you start increasing interest rates, that you should see a deterioration of your currency 12 to 18 months later. That didn't happen. We're going to touch on why that didn't happen. And all we've seen, in fact, is the dollar getting stronger and stronger and stronger. And all we've seen is US markets doing better and better and better. Of course, we'll touch on those specific companies that drove that. But what the rest of the world has just seen an outflow of capital. Whether investing in US equities or US bonds, we've literally seen the US suck up all the excess liquidity to their markets, and that's why we've not seen similar moves necessarily in our local markets. So I think that's just kind of a little bit of a background. Let's start with the interest rates, inflation, that whole story. I don't know, Etienne, if you just want to kick us off interest rates, inflation, and then we can go on from there.
Yeah, look, I think it was basically second half of 2021 that saw inflation really getting a problem. I think they just read that 4%, they said, was the lowest since September 2021. But when it started to become a problem, 14-year highs, see drastic increases in interest rates. And with that, we've seen inflation now coming down, but as they usually say, it's more sticky to come down. So it's almost like what tend to see the rand depreciating very quickly and then strengthening for most of the time after that, but taking a very long time to gain that back. So I think we're now back at 4%, and everyone thought that it would be able to come back to 4%. Yes. I think now the issue is where would it settle? A lot of some people said initially 2%. I think that's basically off the table. I think definitely 3% at least, but somewhere between there and 3%. We should see that settling now, but definitely a new normal. I think that's very different for the longer term.
Maybe not the 2% that we got used to. Renita, I don't know if you want to weigh in, or Darby, if you want to say something.
So I touched my ears.
Darby goes behind to correct everyone.
Yeah, so it just listens to what everybody says. But my opinion is also, I think, it was like Etienne says, it was easy to get it down, from 9 to 4. Yes. It's going to become a little bit difficult. If you look at the biggest constituents of inflation, it is the property market. Yes. We've seen that property prices has been quite resilient in the US, especially on the second-hand property market and also on the rent side, because not a lot of people are buying properties anymore, so they're rather opting to rent, which is also, keeping the rents quite high. The landlords have that negotiating power at the end of the day, which is a very good thing. And then the other thing is healthcare cost. Healthcare cost also takes up a big portion of that basket. That's also staying relatively quite high. That's going to be more difficult to get down. For stuff like property, you can do it through interest rates by almost smothering demand at the end of the day. But the big problem is property, the supply. There's not enough supply on property. So the interest rates can have the effect. It's going to take a lot longer. But stuff like medical, the medical side of things, it's going to take some time. And then also from the consumption part, that's also a big element of inflation. that you've seen now consumption is starting to come down. Not that the employee or the US citizen is in a bad position, money-wise. They're just not opting to spend, rather opting to keep some of the funds back. So that's I think that is going to be the differentiator, whether inflation can come down to 2% and what the Fed stance is. The Fed unfortunately, the whole time looks at these data points. The data points, unfortunately, they're historic based. There's no data points that point to the future. So they all the whole time making basically decisions on data that's already behind us. And the thing is that you've just mentioned with interest rates that take 18 months to start reflecting in the economy. We're basically getting there right now because in March 2022, they started raising rates, right? So it's more or less now where the impact is starting to be felt more acutely. So that's going to bring inflation.
And I also think other risk factors that it's very difficult to quantify at the moment is the geopolitical risk in terms of oil, energy prices. We've seen a much warmer winter last time around in Europe, with the natural gas prices coming down, but in the last couple of days that started rising to rise again. Energy prices and then this whole El Nino thing with irregular weather patterns over the world. Food prices are extremely volatile. So that's the dark horse that is unfortunately you can't control via interest rates.
Frans, I think also just, I mean, if you look at it simplistically, there's two levers of government, it's monetary policy and fiscal policy. Now, everyone's been focusing on monetary policy since inflation started becoming a problem, because that's usually where people go to push up interest rates and lower inflation. But no one has been looking at the fiscal policy side of things. And what is happening at the moment, it's been happening since the start, is you've got an expansion in fiscal policy, while you have monetary policy that's being tightened. So two is working against one another. You'll never get inflation down to 2% if you're increasing your budget deficit by 700 billion, you said that over the last year. I mean, nominal GDP growth was 1.5 trillion. So that's almost half of your nominal GDP growth just from the state spending. So, I mean, that's what's giving this impetus to the consumer. You keep on spending to keep inflation higher. So you've got monetary policy, which is basically a handicap because you've got 30-year mortgage rates. So house prices, the housing market or real estate market's not reflecting the high interest rates, and which is kind of keeping the wealth effect high for consumers. And then you've got the expansionary fiscal policy. So on the one end, they're feeding inflation from the fiscal policy side of things, and the monetary policy side of things aren't really doing what it used to do. So that you'll never get inflation down. You'll have to push up interest rates to 7-8%, and then hopefully in a few years you can maybe reach it. But I think it will probably come down more gradually. But I think that last 1% or such 1.5% is going to be difficult, especially if your fiscal policy, if you keep on running budget deficits. I think that they have now.
That's why they talk about sticky inflation. Sticky inflation.
Yes, exactly. Absolutely. Please. Preferably, yes.
I can't decide language.
Thank you. Okay, they made a couple of very interesting important points here, and I think I would like to elaborate on a few things. One is your comment about inflation getting it low to 2%. That is indeed going to be quite tough to get it down to 4%. That's the comment. And to get it sustainably down to 2% is really going to be very quite tight monetary policy for some time. The comments about the property market in the US is important, but it's important to understand how it works, because they locked in their interest rates on properties. It's a capital market based interest rate. So you get this weird situation where you get an increase in interest rates in the United States and at the same time a shortage of property. Yeah. So because people are sitting on low interest rates, they don't want to sell because the low interest rates locked in, so they don't want to sell due to the shortage of stock. And that is usually the channel through which monetary policy affects wealth and therefore consumption in the economy. So that channel is quite weak. A couple of comments about fiscal and monetary policy, which is very valid. Fiscal policy is by far the strongest policy instrument if you want to get inflation down. But fiscal policy is the unpopular one to get inflation down, because fiscal policy means that politicians need to take a stance on cutting on state spending incredibly or increasing taxes, which could have far more direct impact on inflation and a much stronger impact on inflation. Monetary policy is a very rough instrument. It is a broad-based policy. It's a very precise policy, and it takes a long time before it's got an impact on the economy. So monetary policy is not really the preferred policy instrument if you want to get inflation out. But of course, it's good. And the same should happen for South Africa. We have to appreciate the situation in South Africa where the Reserve Bank is really fighting the losing battle here because you've got this overwhelming unsupportive fiscal policy and this overwhelming non-competitive macroeconomic environment. You only have this little stick to fight it on, and that's monetary policy. And then maybe a comment that's worthwhile about the American fiscal situation. The outstanding debt of the Americans is approximately 34 trillion. This is a horrible 34 trillion.
Not even fit on the screen.
Yeah. It is approximately, is it 100? I've got a zero missing somewhere.
It's 130%.
No,
Oh, right.
120% of GDP, but what's it per capita? I think it's 100,000 capita, I think.
Oh, that's around 300. So.
Yeah, per capita. This is a really big number. About 3 trillion of that is held by the Chinese. And people say that the Chinese gives the Chinese this huge leverage over the US because they can dump these bonds. That's nonsense, of course. Because you want to sell the bonds, then you get dollars in return. So what do you do with the dollars? But the Chinese are already getting a little bit uncomfortable because of what happened to the Russians with the sanctions against the Russians. So they certainly would like to reduce the holding of US bonds over time, the treasury bills, as they call it. But the reality is that the US debt levels where it is, not only where it is at the moment, but the rate at which it is really something that I think everybody should be considering. We have recently been seeing the bond market. That's a question. The long end of the yield curve keeps on going up.
Can I say something? So you usually say that if you increase interest rates on the short end, you actually want to bring down that long. But it seems now what they've been doing in the US, they keep on lifting the short end. Well, they stopped now for a couple of times, but the long end just keeps on going up. What is that?
There are basically two variables, two things that you have to, they work, you get different signals when you look at the yield. Yield curve is basically interest rates over time. Short-term interest rates, medium to long-term, and as usually slope like this.
Yes.
It's all the sort of positive slope of up the sloping curve. That's what the yield curve is. The yield curve, the long end typically of the yield curve goes up because of two major reasons. The one is inflation. So if inflation goes up, of course there's duration and that sort of stuff. But the very important one is if expectations for inflation is higher, then people want a higher return over time. Yes. So the long end of the yield curve goes up. In inflation, in an environment without inflation, assuming no inflation, in the long end of the yield curve can also go up for risk reasons and so on, the so-called duration. But what is important for economists, you look at the yield curve, the long end starts going up in an environment of zero inflation. That tells you the market is expecting future economic growth. That's what it comes. That's important to understand. So why is it going up? Is it because of inflation expectations or stronger economic growth going forward? But that's one point. Another point is this is what you refer to. Is that if you increase short-term interest rates, then you will find longer-term interest rates will go up as well. Yes. It makes sense because long-term interest rates is simply all the short-term interest rates sort of added up together into the long. So increase short-term interest rates and long-term rates will go up as well. But at a certain level, if it increase short-term interest rates, suddenly long end comes down. Yes, that's what you want. And the reason why that happens is two reasons. The one is because the future economic growth is going to be weaker because short-term interest rates will dampen economic growth. And the other reason is that future inflation is going to be lower because of the lower inflation. So what we've seen in the US, they long ends just keep on going up, mostly surprisingly slow. So that's the question. So why is that happening? Is it because of inflation, or could it be the market expecting stronger growth? Yes.
Maybe just a third kind of pillar in that is like market dynamics. Because if you have, like Dolly mentioned, the Chinese hold a lot of government bonds, US government bonds, but they've been net sellers since 2021. They've been net sellers of US bonds. So you've got a net seller in the market, then which is holds a lot of the bonds. So that means that that's a downward pressure on those prices and upward pressure on yields. And then also the US Treasury is no longer buying, or the Fed is no longer buying. So now you've got a major buyer out of the market and a net seller in the market. And when you have that, prices go down, that means yields go up.
Yes.
So that's just the third pillar. It's less to do with economics and more with market dynamics. And I think to a large extent, that's what's happening, because if you look at the break-even inflations, the 10-year break-even inflations haven't moved about 3%. So that means the market's expectation of the bond market's expectation of inflation is still pretty well anchored, in my opinion. It could still go up, but yeah, I think. Sorry?
Around 3%.
Yeah, it's around 3%. The 10-year break-evens. So it means that they're not really worried about long-term inflation. They're more. I think it's more to do with bond market dynamics, so the actual market dynamics, which is driving this latest, which means that it's probably a shorter term. It's not this extreme move that we've seen now to 4.75 on 10-year. That's probably a bit short term in nature, because then if you eventually, when the economic growth weakens a little bit, like Darby said, the expectation if we're reaching, like, let's say, a mild recession in 24, then there are going to be net buyers in the bond market because there's a move out of equities to bonds, and that pushes down yields.
Let's maybe just go over to the election, because it ties into what we believe can happen with the fiscus, is that depending on Democrat, Republicans, usually the one is more in favor of keeping the spending going and the other one wants to increase taxes. So let me just start us off. Yeah.
All right. People think that if you talk about the Republicans cut back on state spending and they want lower taxes. They are more conservative fiscal approach. And people think that the Democrats do the opposite.
Yes.
The Democrats are a bunch of socialists who spend a lot of money and they increase taxes. That is sort of the view of it. If you look at history, that's exactly the opposite. So what's been happening in the past, Democrats have been, over the Republicans have been telling everybody, we're going to cut taxes, we're going to cut taxes, but in actual fact, the opposite happened. But that is sort of the narrative out there which doesn't happen hugely. At the moment, what we have under the Democrats, under Biden, there was a massive increase in spending.
Yes.
So the inflation that they're currently experiencing is mostly fiscal-driven inflation. It's huge under the Democrats in this stage. And of course, the result of that is relatively strong economic growth because of a lot of spending in there. But that is also the result of a huge increase in fiscal deficit and of course deficit. I just want to make an important point about economic policies, and that is monetary policy and fiscal policy. And policy, interest rates 5% in real terms, for example, fiscal deficit of 5% to GDP, for example, are not restrictive or contractually necessarily. It is the change there in that matters. Good point. So if you've got 1% real interest rates and you move to 2% real interest rates, from 1% to 2%, it's not much, but it's a doubling. That is the trigger. It takes a long time before it filters through the economy. Coming back to who's going to be the next president in the US, about the Democrats, or the Republicans, the easy one, it's going to be very difficult to beat Donald Trump. I can't see. There's this new guy, Ramaswamy. I like him a lot. He's really, really nice. I like him. He's going to close everything down. That's what the Republicans always say. But anyway, I don't know, at least it's Saturday. But he's far third at the moment, possibly. So it's probably going to be Trump against. Trump is not a very good choice for the Republicans, but he's so well entrenched that he's really captured the Republicans. Then on the Democrat side, has become bad. Well, for both Democrats and Republicans, is to in the second term to have the same candidate as what they had in the first term. So obviously it's got to be Biden, and Biden is old. I listened to Trump this morning.
I mean, really, not like old, but old.
No, 80.
80.
Yeah.
I listened to Trump this morning. But Trump's not making. I mean, he's running in circles around, and he's making fun of this one. And the reality is, the Democrats, they can't not put him up as a candidate.
Yes.
They can't put Harris up as a candidate again. They're gonna get another one. But she's been very, very unpopular. He is one of the most unpopular presidents in the history of So that's a dilemma. So it's Trump, Biden, and I think it's pretty clear it's going to be Trump. But Trump is going to be the next president. This time around, it's going to be different. And it's going to be different. The reason why I say it's going to be different. It's the first time we won a presidency, everybody, including Trump, was surprised about it. Nobody thought he's going to win the presidency. This time around, what he's done already, and I've read a number of reports about this, is that he already established, he's got his cabinet ready, he's got his plans ready, he's got his policies ready, he's got everything ready. And the day he walks to the White House, things going to start happening. I'm pretty sure of that. So this time around, he is going to be different. What it means for international politics, I mean, it's very, very good. So at the moment, I think if Trump walks into the White House, the Iranian war is over within a month. Wow. It's going to be over. He's going to squeeze Zelensky to abandon Krim and to abandon the Donbass area. So that's it. That's it. Whether you like it or not, I take all my weapons away or we give that. So that the war is going to be over. The war in the Middle East, that's a bit of a different one because recently this is a new war. We still have to figure out what's going to happen here. So it's going to take some time. What has been happening recently, the most important what you is friend, is that the right word? What's it? Ally in the Middle East, where the Americans were Saudi Arabia, India, Afghanistan, Israel. Now, recently, especially under Mohammed bin Salman, MBS, what's been happening is that Mohammed bin Salman, MBS, he's got some ideas of what he wants to do with Saudi Arabia. One is he wants to establish Saudi Arabia as a regional power in the Middle East, which includes nuclear weapons. Yes. And he told the Americans, okay, we will keep on buying $200, we do all these last things, but he provided me with nuclear technology, and the Americans don't want to. So there has been a bit of a cold week between the Saudi Arabia and the Americans recently. But what's also happened, Saudi Arabia and Israel have been getting closer to one another recently. But this war means that the potential real peace deal between Saudi Arabia and Israel is out of the water. That's not the reality. With Trump in the White House, I don't know. I don't know. I think Trump is going to take a strong stance in favor of the Israelis, I would guess. But that's a bit of an open question. I'm not really sure how the politics is going to play out.
Let's maybe just end this section. I think the US, and then we'll go over to South Africa, and then we'll tie EM to that whole story. But so what I'm hearing is that at least for the immediate, so let's call it year 2, 3 years out, it seems as though the US will remain very strong. And inflation should stabilize at these levels, let's call it 3-ish%. We don't necessarily need more hikes. And then that they can actually pull themselves through now with supportive fiscal policy through a recession type correction. So that means strong US, strong markets and strong bond markets. Or do we see it differently? Etienne, I don't know if you want to jump in or Denis, but maybe what's our expectation, US markets, the next couple of years? Because we have a large allocation in our portfolios. We produced that. I think when we started in 2016, it was 55 or 58%. Now down to 41%, 42%. So how do we see this play out?
Well, look, I think it's all going to depend. This inflation is going to be sticky. So I think maybe we haven't seen the full effect of all the hikes we've had. But definitely, I think they'll be very reluctant to decrease interest rates quickly. That they got a big scare with this, and I think probably going on now, as we've seen in the past 10, 15 years, it was winning down. There was more QE, more loosening.
Yes.
And I think now winning down, it will be rather tighter than looser. So I think that will put to a certain degree pressure on the consumer. Consumer is still in a very strong position. I think they need a soft patch, some type of recession for the labour market to get that completely under control and get inflation under control, sustainably under control. So I think we're not far from that, but I think we will see a weak patch. Consumer is weakening. So But then again, the stock market is a leading indicator. So you see the reaction on, especially some of the consumer discretionary stocks like Nike.
Already down.
Already down far, 30-40% from its peak. So, I mean, already pricing in less spending and a slowdown. So I think going forward, we're in a more normal situation. Maybe that's why the longer-term bond yields are high, because the expectation is that longer-term inflation will be a bit higher. But also, longer-term growth will still be fine, not above average high, but still good. So the economy will be able to grow with slightly higher growth. It's positive interest rates and slightly higher inflation and interest rates than we've seen. But I think investors in markets, selection is going to become very important. It won't be just like the QE, blanket wave of everything going up. I think companies employing capital efficiently, companies with a proven track record of actual profitability, and not just this pie in the sky idea of whatever's going now. AI is the newest light, but again, people that can actually monetize that, not just ride the hype, because capital is now a cost to get. You can't just spend on R&D unlimitedly, appoint people and just postpone the process and say someday we will make money. So I think selection, much more stringent thing. You see a much bigger diversion between the good quality companies and some of the lesser quality companies. The companies, good management, good efficient deployment of capital will get rewarded, and the rest will be punished severely, as we've already seen in recent times.
Yeah, I agree with everything that Ed said. I also agree with Darby. If you want to take the macro and you want to pull it through to the stock market discussion, then you need to look at over the last decade and a half. Inflation was actually, we had some of the most consistent inflation on record. It wasn't volatile. That's a big thing. You know, in that environment, investors, advisors, they can make predictions. It's much more consistent. So what has happened, unfortunately, the last 2.5 years, this inflation has been around 2.5 standard deviations around the mean. That has made it incredibly unpredictable and that's also why the bond market, the whole bond curve is lifted. The bond, it's not just that the curve is open, the whole curve is actually lifted as well. So it just means that investors are a little bit more concerned, because I agree with Darby, you're building in a higher risk premium, because the credit spreads widen because of that credit default risk. Also with the US, the amount of debt that they have, it's becoming a concern. I mean, the interest expenses are approaching $1 trillion. It's 1/7 of their budget that just goes into paying off interest. If you think Eskom has problems, the US also has problems, you know, so it is still a problem while interest rates are high. So when interest rates start to decline, the problem becomes a little bit less, you know, so I think hopefully they see that they can get through this period. But going back to my original remarks is that for the next while, I think we're going to get much more consistent inflation. So even though it's high, it's between 3 or 4%, which you can make your pick. Nobody knows where it's going to settle. As long as it's just at 3, then you can start making much more predictable. Instead, you know, companies as well, their cash flows will become much more consistent, etc. The big thing for companies at this point in time is the consumer.
Yes.
It all comes down to the consumer, and it all comes down to the labor market. Labor market is tight, you know, for a couple of reasons. Because of the aging demographics within the US, there's also been problems around immigrants, you know, into the US, where they've stopped that for a very long point in time. It just means that nobody can actually enter the labor market, which was a big problem. The US now, as of late, has started to allow immigrants back into the US. Now, so there's about 65,000 workers per month that are being added to the US labor market at the moment. That's alleviating some of the concerns, but not even close to all of it. And then simultaneously, productivity is starting to pick up, which is also causing some alleviation in the employment market. But those problems are going to stay, I think, with us for a very long time. It's difficult to get to fill 8 million vacancies, 9 million vacancies through immigrants and productivity. So what I'm trying to say with that is, I think also the consumer is going to be in a very bad position for still some time to come. So if you have consistent levels of inflation, You have a consumer that's earning positive real wages, which is good. Even though they've depleted some of their excess savings, they still got money in the bank that can go and spend. They're just scared at the moment. They just need sentiment to come back. Then the stock market can do pretty well. I think what you need to be cognizant of now is risk management within any portfolio. At the moment, interest rates are high, over leveraged companies, they are the ones that are running into problems. But it comes down to a company specific thing at the end of the day. That's why we believe we're in a stock pickish environment, where you need to choose the companies with the healthiest balance sheets, companies that still sell products. I mean, like Etienne said, people are still buying Nike sneakers. You won't believe it. I mean, for $200 for Nike sneaker, especially the likes of China, people are still buying Starbucks coffees because they've got loyalty memberships. People at the higher end of the spectrum, the rich people are still extremely rich, and they're still going out and buying Gucci handbags, etc. And that is where the inequality discussion also comes in. Through fiscal or through monetary policy, it affects different parts of the economy differently. At the end of the day, remember, somebody that has a lot of cash in their bank, as interest rates go up, they become richer. So all of a sudden, it doesn't affect, they can just go out and spend. Their profit is already paid off, most probably, right? So it comes down to stock picking. I think the returns that clients have received over the last decade and a half, it's not going to be that case anymore.
Yeah.
I think that's a little bit far-fetched. But I do think that
high single digits.
I do think that you can expect high single digits. I also think, what's happening in the bond market at the moment, people are scared of bonds because they require a high risk premium for owning a bond at the moment, just because of what's happening on the credit quality side and with the amount of defaults. You're seeing it in banks as well. Credit card defaults are quite high, close to historic highs. So if you don't own bonds, you don't want to put your money in a deposit account. What do you do with your money? You put that in the money market where you're earning a lot of funds, and also otherwise you place your money in the stock market. You have pretty big growth. And that's actually providing some support to the stock market still at this point in time.
Yes.
And I don't see that capital just shifting overnight. I don't see the bond market just recovering overnight. I think the sentiment is on equities to bonds, back to bonds. Yeah, I think it can take time. It also depends on what credit quality, what you ration. I know that discussion is a discussion on its own, but just bonds in general. And I think that's going to support equity markets for still some time.
But I also think that the whole bond sort of conversation is a lot of people out there don't understand the difference between a fixed interest, like a money market, where you put your money in invest XCC and get your 7 or 8%. And a bond yield that potentially your yield to maturity is 8 or 9 or 10%. They tend to think that's also risk-free. Now, last year, that was the worst year on record for your traditional 60-40 stock bond portfolio because both asset classes were down 20+%. And I think that's the thing. A bond can have as much risk or even more than an equity portfolio in a short term over a sort of 12-month period.
Only if you market to market. We keep it until maturity.
Yeah, but if it's now a long-dated maturity, which is 5 years out, 10 years out, that's not necessarily the plan of the investor parking money that he needs in 6 months.
Yeah, that's it.
So maybe we have about half an hour, about 20 minutes left. Let's start with South Africa and bring the rest of the world into the discussion. I think the politics is becoming an ever more important factor in everything in South Africa, in life in South Africa. And I think there's a lot of questions and confusion and uncertainty about next year's election, and then how that translates into what we expect from the economy. So please, Dawie.
Okay, let's talk about the elections. I hope we're going to see elections. I'm not so sure we're going to see elections. There are two reasons why I say so. The first one, see how the ANC reacted to the elections in just across the border today. How they congratulations on Nangwa after he stole another election. So clearly they're not Democrats in their hearts. Let's be very clear about this. The second one is we've got a new electoral act, so that there are many involved apparently with the legal guide, this electoral act. And it's quite easy to foresee a situation where somebody is unhappy with something, the electoral act, go to the court, get a postponement of the elections, and the ANC is not going to be too unhappy about that. Because the longer you postpone the elections, the longer they're there to do it. So just keep that in the back of your mind. Maybe we're not going to have it. That's a matter of what the Constitution says. Then what's going to happen in the elections? I think most likely, I'm not going to go through all the scenarios. I'm just going to say chances are we're going to see this is a bad scenario with the ANC getting either 50 or around there, or just below or above, but they will still be in government with the support of the smaller political parties. It is possible that they get much there, but that's a bad scenario. A worse scenario is if they get, say, 45, and then that will be in some sort of new political leadership, which can include Paul Masachile, for example, and other brilliant people like Bikile Balula, for example. So that kind of scenario is not possible. That's a worse scenario. And then at the end of next year, the second year will come to an end. Turkey already indicated that they would like to see the mandate of the Reserve Bank change, and they will have to decide who's going to be the governor of the Reserve Bank. There's a lot of risk in it. So I think it's more of the ANC, more of the same for the next 5 years. Another 5 years, another 5 years. The major challenges are local authorities. I can give you the numbers on that from local authorities, state-owned enterprises. We know what's going on there. It's a mess. Maybe we should talk a little bit about the national accounts. Yeah. So maybe we can talk about that as well. So those are the 3 major challenges to where this government. And these guys caused these problems. They are not going to fix these problems for various reasons. In the local authorities, that's where you gain the employment, that's where you get the contracts, and that's where you're paying them good. Same goes for the state-owned enterprises, and pretty much for the national departments as well. So yeah, it's more of the same, and I can't. And I think we can do also numbers on what the economy can grow if you have limited electricity. What's going to happen to the economy if the railroads just not work, collapsing all over the place. And many examples like that. But more of the same ANC funds.
Well, more of the same means more deterioration of government's influence and power to a certain extent. So what I'm asking is, what we've seen, and you've explained it well in the past, is they're basically selling all these companies.
They're privatizing. But what is happening is the post office is a wonderful example at the moment. They've just closed post offices in South Africa. So the post office is just coming to an end. Yeah, it's just not working anyway. Post office is going to the liabilities exceed the asset by 12 billion. And they want to start a state bank, and the post office bank to start a new state bank. That's it's that money, that place puts about. So that's a good one. So the private sector is just taking it over. The private sector is not allowed to distribute debtors. Private sector is doing it because if you don't do that, then you're not going to get the debtors. And so the private sector, it is in a way, it's the backdoor way of privatization. And it happens. In some instances, like the railroads, they are selling some concessions on some of the railroads now. They're almost ready. They've done that already. There's the 20 here. They are getting private sector to run this power station, Rooiwal. Private sector is taking over that. And then all of the 20 is talking about the private sector taking around over as well. So it's happening at all sort of levels. And that's good. That's good news. But the problem is, and why do you have to wait until everything is broken before you do something about it? And that's very, very expensive, this crisis.
No, it is expensive, but I think just from the conversations that we've had with many of our clients, a lot of them are stepping into those caveats.
Can I just make a comment about the electricity, what is happening? You and I have done that. Eskom has lost about a third of its market across the world. Because people are getting more savvy using electricity, because we're putting solar panels on the roof and other solar groups. Investments in South Africa is quite dramatically in the last year or so, but it's mostly because people are buying solar panels and replacing it. That means people are buying less electricity. Eskom is in trouble as these financially around. And the local authorities make most of their money out of reselling Eskom's electricity. That's this. So the local authorities, they're selling less, but not only that, they take the money and they deposit the money, don't leave it to Eskom. And they owe Eskom 70 billion already. So what happens is that some businesses get court orders that they violate the customer. So it's the local authorities. And that's another way of privatization. Because the last mile, the distribution part is being privatized. Exactly. And maybe we should talk about the national accounts. But
Yeah, so let's maybe go on because I think that, so we're saying it is tough on the local market and it's been tough, specifically on the local equity market for many years now. I think most of our clients are in balanced portfolios as well. And the income is really doing well, but it seems as though more pain, yes, but does that translate into more pain for South African equity markets as well? Because I think it's easy to only look at South Africa, small open economy that it is, and forget that we are playing in this bigger arena as well, where there are emerging markets climbing out of their closets again. India, we really like India. And Christian gave an amazing market call on the Indian growth, the incredible Indian growth story. So we see that coming to fruition as well. We're not expecting China maybe to remain where they are. So that can maybe help us out from the external side because we know it's not going to come from the internal side. So if you're stuck here, you have to make it work. I get that. But does that mean our equity market is just going to remain flat for 5 more years? That's my question.
And so I think first of all, it comes down to liquidity. Always in South African markets, what can actually lift the price of a company higher, right? And we got a couple of institutional buyers within the country that has large stakes in companies, and those are the guys that really move the prices. Standard banks decide they want to buy Redefine, they're going to move the price 10% up, overnight. But it comes down to basically what are the institutional guys doing at the moment. If you want to have the discussion, on the South African market as a whole, we know that the market is not the economy. So even doesn't matter how bad things actually get within South Africa, the stock market can still move higher because we know that about 70% of our revenue are actually generated outside of South Africa.
Yes.
So the rand has a much bigger effect on actually what's happening to our company's earnings, etc., and whether offshore investors wants to come in and whatnot. So it is a little bit different than just looking at how's things going in South Africa. First of all, look at institutional buyers. First of all, look at the demand, how things in developed markets. Are things a little bit saturated? Do people look to shift their money elsewhere? Usually to emerging markets, to China, India, South Africa. That's going to lift our asset prices, bonds and equities. I'm talking very broadly now. That's extremely, that's very, very prevalent. And then the other thing is that, a lot of times, for example, now things are so bad in South Africa. I mean, load shedding are weighing on these companies' earnings big time, and as inflation as well, and demand has completely dropped off. And you have supply chain issues. Let's not even start with that in terms of commodities. These can tell you all about that. Somewhere that also forms a base where things are so bad, the next period when they report, things can only start to get better. As a matter of fact, it's like Darwin says, a lot of electricity are being privatized. To that extent, a lot of corporates are also putting in solar, especially some of your mall operators, etc. So they don't have that set cost, that fixed expense in year 1 anymore. The next year, that's not in the numbers anymore.
Yes.
And then it starts to lift. So yeah, I think that's extremely important, that the South African markets are extremely cheap at the moment. There's sectors that just offer so much value. Unfortunately, 30% of our index is tied towards commodities. So all matters what's China doing at the moment.
That's it.
And with China, what investors are watching there is the property market. So, the property has been in complete doldrums. Property prices has just come down. So that has actually diluted the wealth effect. Chinese citizens aren't feeling that wealthy. They aren't spending as much anymore, unfortunately. So what we're looking there for, even though China's actually pretty healthy to a certain extent, it's just that sentiment needs to return. The property market is the core of that. So when the property prices stabilize and it starts to grow, then investor sentiment will also shift towards China and to South Africa to a large extent. And that all that depends on what's happening also in developed markets. So we're watching that space quite closely. Emerging market for me stays an emerging market always. It's a market that you must take it for what it is. You must trade it more than anything else. Very difficult to identify a company and to hold it forever. I think the days of Naspers and of BATS and of Anheuser, I think those days are largely behind us, and of Capitec. just keeping on taking market share and playing into the right space. You will have to be much more active going forward, because I've had a conversation as well. Everybody's talking about Singapore at the moment, and about Vietnam, and about Southeast Asia just getting richer and everybody immigrating there, and the skill set just improving. But unfortunately, with that, also competition increases. So the companies that operate there, they have to obviously take more out of their pocket to stay competitive, and that then weighs on margins and it affects companies. So it's very difficult to see something just moving in one straight line. At the end of the day,
It is. You usually say that the South African stocks are now sub-par price, sub-par price.
Yeah, look, I think it's all about, like you say, individual sort of opportunities. At a certain stage, Standard Bank growing earnings still, or we high single-digit figures or mid-single-digit figures, paying a dividend of 8%, trading at a P of 6. Your risk is limited in terms of somewhere you get a risk on a period where all emerging markets, that the dollar gives a bit, weakens slightly, emerging markets, everyone dwells in, commodities prices go up, and then it just re-rates 20%, 25%, 30%. But then, unfortunately, that's why you need to trade that a lot more, because locally, you're not buying into a nice story. We're basically buying into a story that it's more of the same. So today, at any given stage, most are priced in, and probably a bit too much has been priced. But unless there's a major change, I think that we've seen after COVID, Massmart, for instance, the earnings, they expect terrible earnings, that they're expecting to come down by 90%. And then it's down by 85%, and then the price goes up because everyone priced it as if it's there. And now it's just, if you priced it for stage 6 load shedding and the average was stage 4, then it's better than has been priced in. Same on the rand. It's no one's saying you're buying into this, to an Amazon or a Google or a Nvidia story that can last forever. But for now, it's less bad than has been priced in. Or it's more bad than has been priced in because it's now had that 30% value from the too cheap to too expensive. And then you need to. So it's much more a range-bound trading thing, but there's still opportunities if you have a 7-8% of that. I mean, that, and you buy the stock at multi-decade lows or low valuations. You still have, I think, limited risk to the upside.
Yeah, I think Renew made a very valid point in saying one has to remember when you're investing in emerging markets. In emerging markets, it's different than developed markets. It is more volatile. It does take a longer time to unlock that value, but your return potential is higher.
Yes.
I kind of disagree a little bit with Etienne on this, not the story. I think there are a lot of nice stories. South African stocks, not necessarily the big ones. It's well known. I think there's a lot of value in a lot of businesses that are listed in South Africa. I think Efficient Group is a prime example. We had a lot of potential. We were listed, big guys came in, took us off the boards, and that's what's happening in the JSE. We're seeing it every day. How many companies? 33 companies listing this year alone. So Pepsi buying
bankrupt.
Not because it's big international businesses buying our companies. So that means it's just sentiment that's against the bourse. Those valuations aren't being unlocked, but that doesn't mean there's not value. That doesn't mean there's not good businesses, extremely good quality businesses, which is your foothold in Africa. Something like a Imperial Logistics, fantastic business. That's what Dubai Ports bought it. I mean, why not buy it? It's extremely cheap. There's a good story there. Company's proven its resilience. I mean, the last 15 years, if you can survive that, it's a good business, and you're buying it at dirt cheap valuations. Just on the emerging market, I mean, if you look at our assets or our companies relative to the other emerging markets, which have all got their same issues, I mean, David will probably be able to highlight all the issues with Brazil and in Latin America, those types of emerging markets. We are sitting at a discount to those emerging markets. If you look at our banks are capitalized better than almost the US banks are capitalized. You've got so they're safer in that sense. The credit growth is being robust at 6%. So it means they are getting a new business. We have seen a little bit of an uptick in credit losses, the latest results. But I mean, that's not, hasn't even like reached the scare parameters, if I can call it that. So I mean, and you're buying that at a discount, not only to developed markets, but relative to emerging market peers. So let me, I'm not going to sound too overly bullish, but I mean, it might take another 5 years. Who knows? We never know when that sentiment change is going to happen. And the same thing is happening at the moment in China, because Chinese equity also, I mean, there's dirt cheap valuations at the moment. They've got a lot of great buying opportunities in the tech space. One just waits for the sentiment to turn on. We spoke to a Chinese analyst from UBS the other day, and he agrees exactly. There's nothing fundamentally wrong with the businesses. They're growing their earnings. It's just valuations are extremely cheap. I mean, look at the last holiday week of that, and autumn week. 830 million people traveling in 1 week.
So,
I mean, what's our population? 65.
yes.
That means more than 10 times our population traveling in 1 week by car, train, or whatever. They spend 980 billion renminbi. Now it's 6 to 1, 7 to 1 against the dollar, so you can work out. That's just in 1 week. That means the consumers they've got a lot of dry powder they can spend. It's been the highest traveling revenue they've ever seen in history, the Chinese. So, I mean, there's a lot of, that's two things I think on the Chinese front. There's a lot of people, and they've got a lot of cash.
Yes.
So businesses can make money. The companies are showing it. They are still growing earnings. It's just a sentiment game. And I think the same thing in South Africa and most emerging markets, ex India, I suppose.
I agree with that. What you're seeing is that the companies are just getting cheaper. So it means that they're growing earnings, but the multiples are just compressing. So what you usually see is, and James, the analyst that we spoke to, he said that, well, the Chinese analyst, he basically alluded to the same thing. You can look at the Chinese profit, or the Chinese valuation on the market. Always it moves between a band almost. It is as if it is more traded. When it gets to P of 9, then you almost have a jump. When it goes to 8.2, then usually there's some type of a recession. So it's all about determining actually whether the market, there's something fundamentally wrong with it that it's going to go through that level. And then, but you need to trade the market, and the big thing is the research, especially in your developing markets, there's not a lot of research available on these companies. So there's a lot more money to be made because there's a lot of mispricing in assets, a lot more. Whereas in developed markets, I mean, there's 35 guys that's following a company like Microsoft, and you can look at a company like for example, Bedfast or something, and there's 9 guys that follows the company, and that is one of our largest companies, right? So it's just as if there's much more baked into the asset prices in developed markets, which makes it a lot easier to invest there than in emerging markets. But I agree with Christian, risk return. Yeah. You can get a lot of return. No way to look.
I think if you look at your big institutional guys, that's big businesses, private equity, those types of guys, look what they're doing. And if you want to bet against that, then you're very brave. And I mean, they just got a long enough time horizon to unlock that value, I suppose. So then
let's maybe end there and see if there are some questions. Anyone have a question? Yes, yeah.
Just the 2 asset classes we haven't spoken about. Firstly, property, and secondly, crypto. Property, evaluation and COVID about 35%.
Global.
Sorry, I'm talking about local. And year to date, 32 degrees up 25%. No, 52%. So just the impact of the property market on South Africa. But then also what I'm quite interested in is crypto, the losses, with FTX and everything going on. What is the impact of all that crypto losses, and how does it impact global?
Once you take it over,
our property is pretty simple. They've overinvested. They expand. I mean, there's a mall around every corner. It's just too many retail space. The retail space is way overinvested. People aren't returning to offices, so the office vacancies are sitting at 20%. So the fundamentals are extremely poor. They've got too much assets and not enough people filling the spaces. So that creates, from a fundamental point of view, it's very difficult. So that's why your guys with offshore exposure have done a little bit better. But the national property space also has its own problems, but let's speak about South Africa for now. That being said, it's extremely cheap. When things get extremely cheap, there's irrational investor behavior that sell it down more than it should be. And then you can make easily 25%, but calling the bottom on something like that it's next to impossible. So, I mean, you can fish and you can make good returns, but if the fundamentals are looking that bad, then it's very difficult to call that bottom and say where that actual bottom.
Yeah, but I also think in the short term, more people actually returned than a lot of people expected. But in the long term, the potential is limited because the structurally has changed. So a year or two ago, everyone expected like the no big companies almost to return, and a lot of them have now started doing that. But yeah, so I mean, again, the expectations was absolutely down there, and then it recovered to some degree. And that's
a lot of
it was basically priced as if there was going to be no recovery, and then it recovered. But I mean, it's now structurally there's less potential, and then also this like the super regional malls is just falling completely out of favor. The real big ones, but let's Castlegate.
Yeah.
What they call that? Strip mall, but it's a better
Lifestyle see.
yeah, man, it's so
Affluent.
it's no. But yeah, I mean the sort of smaller retail space have proven to be much more resilient. So it's a massive change in sentiment. So it also depends on the time, because I think there was 52 listed property companies on the JSE, and I mean they're vastly different in terms of local global split and in terms of office space, commercial, industrial. So yeah, that's it's a very difficult question to answer, because some places have recovered well, some have actually improved, but the end of the thing is that the pool have shrunk, because there is that percentage of people that is willing.
And on the company themselves, it's also it is broad. I mean, you've got storage, you've got office, you've got retail. But the big thing is that if you look at the sector as a whole, most of the earnings is actually coming from Europe. More your European countries, and they've actually kept up pretty well. You know, especially from malls, etc. And the rand has also supported it, with the rand that has weakened. So those companies, there's a lot less mispricing taking place there. You know, the redefines, for example. But the big thing is the loan to value. You know, the loan to value inside of South African property operators is extremely high. You know, so with interest rates actually increasing, it's really it's impacting their earnings, the bottom line. And additionally, they had the expense also of implementing their own solar, etc. You know, whereas if you look at the US, for example, and you look at Australia, the loan to value is at 30. Those companies don't have any debt problems. So with interest rates that can rise, it's not going to impact their bottom lines. That's why the guys still like offshore property a lot. You know, in offshore property as well, you can play into the retirement space. There's logistics. There's now data centers that you can buy. Not like in South Africa, where you only basically have office, retail, and storage, unfortunately. So
I don't think I'm going to do the crypto question now. Are there any other questions?
Wherever buy let's say. How many efficient product line basically put in the very component of the topic? And I get what the reality lost out.
Oh, het wel. Wat moet daar?
We zijn bij jou door het praten, het weer per se, maar
Wat moet
we nog beter weet.
Goeie vraag. Ik stel weer eens.
Ja, ik denk het gaat alles afhangen van wat met die local handelen kan best be support. Die moet zaken gaan draaien. Ik hoop het ook 18 maanden en daar gaan was een paar factoren wat het gaan bij. Wat gaan gebeuren op ontwikkelde markte? Gaan ons recessies zien in Amerika, gaan ons nie recessies zien. As ons 'n resessie gaan sien, is deel met ek negatief vir die emerging markets. En ek dink dis wat die mark nou al begin vooruitsaag skiep het.
Wat verwag jy gaan gebeur?
My verwagting is,
Wat jy verwag?
hoogste waarskynlikheid.
Wel, emerging market, hoogste waarskynlikheid is dat die dollar van waar hy nou op 1,05 sê teen die euro dryf, dat die dollar met 5 tot 8% verswak in die volgende jaar. En dit behoort positief te wees vir emerging markets as geheel. So die emerging market en China exposure saam met wat Renier nou gesê het van die valuasie JD.com en aan Tencent daardie goed gaan redelik opspike. Kommoditeitspryse op van baie lae basis af op platinum. So dan is die grootste deel van die portfolio, 60% van die portfolio, kan dan baie goed doen. Maar dan vir jou 'n baie goeie opbrengs gee. Global, dan alles af van die rand. Ek dink die rand baie sleg so is ingeprys. Die rand behoort is eintlik R18 toe terug te kom dan as sonder die rand iets op sigself doen as die dollar verswak. Nou selfs 17.50, maar soos wat daar gesê met al die verkiesing onsekerhede is dit dalk kan dit dalk 'n cap op hom plaas. Ek dink alles is ingeprys nou op die rand wat voedselpryse is voor iets nie verander voor daar nie nou 'n moeilikheid in die verkiesing. Dit gaan ek nie regtig kort voor die verkiesing kan dalk meer wisselvalligheid sien. So ja, ek dink die oorsese exposure gaan so ons sê wel single digit, maar as die rand bietjie versterk, dan gaan die oorsese blootstelling nie noodwendig vir jou negatiewe opbrengs gee nie, maar en of sy vir opbrengs gee plaaslik in emerging markets proper workable cycle.
Goeie 18 maande wat voor.
Tot watter mate iets hoegenaamd die rand tot 18, want ek het klein drukkie terug, nee, was ons ideale waarde 14.50, te vir 'n klant 17.50, nou hoop ons nie meer 18 te sien. En dit lyk net my intrek, en ek wonder of iets beteken, hoegenaamd moet ek verleer.
Dit lyk net geen prentjie van die dollars baie staan. So dis tweeledig. Die rand is obviously baie oorverkoop in die korttermyn. Dit is volgens die hele paar groep. Ek dink angles, maar die dollar, jy moet eintlik die dollar tot 'n baie groot mate ook opbou, want as so hulle sê as inflasie baie mooi afkom en die Fed begin baie meer gemaklik raak en daar's baie meer stabiliteit en sekerheid in die wêreld, dan gaan ouens uit die dollar uitklim. En of hulle dan nou weer terug gaan bonds toe, dis die vraag of waar hulle gaan, maar hulle gaan nie meer in dollars sit nie. En dan ook as rentekoers verder afkom, sy nou baie kapitaal in dollar moet vasgemaak. Dit so die natuurlike, die 101 antwoord is dat die dollar moet verswak, ongeag wat by die rand gebeur. En as volgens my groot met kapitaal wat uitvloei, word die rand gesluit raak.
Maar ek dink, wil jy iets sê oor die langtermyn draf?
Maar hier is nie langtermyn. Ek dink nie langtermyn is ons steeds van die
Hy praat in die langtermyn, dis nie maar die verswakking. Ja, maar jy maar nie beleef soos wat die tyd aangaan.
Dit is net so dat jy kras issue is as jy een diskresionêre som geld som van die play. Dan mens net seker maak dat jy dit nie op 'n extreme waarde as jy dit in 2005 gedoen het, R18.50, dan het dit vir 7 jaar gevlaat. So dit is fyn om dan te onthou, dis 'n langtermynplan, maar die klient onthou. Gaan nie so lank geduldig bly en die hele tyd sê dat soos dit nie gedoen het. En as jy dit teen R19.40 in 2020 net dan, is jy ook nou weer 4 jaar aan. Die res van die tyd as dit min of meer binne 'n range is, of dit nou 17 of 18. Kom sê, as hy nou tussen 17.50 en 58 of wat is, waar jy dit nou kan doen, maak die saak nie, mense net nie dit op 'n groot spike doen nie. Dit is fyn, want die langtermyn is fyn. Kliënte kyk die hele tyd terug na daai ding. So dit hang af van die expectations wat mense moet manage, want hulle wil altyd weet, hoe kom het jy nou toegelaat om dit op 19 50 te doen, want hy dan teruggegaan eers 14 toe voor hy daar gekom. So,
Daar wil ek iets sê. Ja, as die Portugese saamstelling probeer is natuurlijk die vergewe ons dat hy net wel is. Goeie vervolging is dit.
En die is nog beter om 'n goeie vervolging te kry.
Ja, en ek verstaan ook al die gevra, maar ek kan ek sê is my groot werk is om die kliëntie te bestuur.
Kom ek gee julle 'n scenario.
Enige kliënt is gemaklik as jy die belegging. Omdat dit nie 'n jaar en 'n half gaan is, is dit net vir.
Ja,
Ek gee nou 7 jaar of 10 jaar breek.
Kom ek gee julle 'n scenario wat 'n vakgeleer op die plaasekonomie. Die fiskale tekort hierdie jaar, die staatsskuld nou, staan op 5 triljoen rand. 5.000 miljard rand. Dis 73% van dit. Dit sluit Eskom en die ander parasitale staatsskuld. Die staatsfiskale tekort hierdie jaar 6% van dit. Ja, ek hoop jy nou al die woorde geskrets. Plaaslike owerhede, staatsbeheerde instellings, die inkomste wat as 'n kanon is, wat ons kan hier kry die commodity cycle is al die hawens is al kanon is al wat staatsamptenare kry te veel verwagtinge. Die fiskale tekort is so 6% van dit. Dit kan ons eintlik die jaar op 75% doen. Daar's 5 finansiëerders wat spyt van ons. Jou is die plaaslike versekeraars, pensioenfondse, die savings-industrie, dis ons. Plaaslike banke, die buitelanders. Dis die 5 grootes wat die plaaslike skadegoeders finansier. Die buitelanders vir al die Amerikaners en Europeërs is besig om tot 'n top staatsbediening te word en 'n klomp ander. Hulle het onttrekkingskrag. Dis hoekom die waardasies is waar dit is. Daar's 'n Amerikaanse genoem as jy nou lei die aardtipe van klok ernstig. Kom die Amerikaners nog meer die Europeërs kom tot weer om 'n staatseffek te kom op die mark en die wetenskap op opbrengskoerse van. So wie koop baie goed? Dis die ouens wat die meeste koop. Dis die banke. Ja, banke koop die meeste. En die reservebank iets kleiner hoe dit op gesê aan die worry oor banke. So nou sit ons in 'n situasie, die banke is nog fyn. Daar's nog nie visie. Banke is goed gekapitaliseer. Maar nou sit ons in 'n situasie waar die plaaslike owerhede nog kan ons klaar, die staatsbeheer, die staatsfiskale rekeningskamer en die balansstaat van die banke is swaar gelaai, staatsbeheer. Dis 'n situasie by ons. So wat gebeur nou? Nou is daar 'n krisis van die kapitaal. Daar kan 'n klomp krisisse dink wat kan. As 'n land lys van goeders, kan eksterne wees, kan interne krisis wees en alles sal emerging market wees. Maar dan die rand verswak daarmee of daar's die een of ander ding binnelands wat altyd klok aan die binnekant. Nou, styg die landkoers en 'n bietjie en die rand verswak kan bietjie met raak 'n negatiewe voet die plek loop. En plaas begin iets te raak en dan weer saam van die rand opbel. Dan kom jy terug na die equity. Omdat sulke omstandighede wat die equity skort koop. Equities wat jy koop is handverskansels. Dus ek laat dat 70% soos ek sê, so randverskansels sou gaan. Ek hou van commodities as jy 'n sterk commodity cycle het. Weet jy net nie wat hoe gaan die goed in die grond en kry nie dit elektrisiteit. Weet ook nie kry hulle by die hawens nie, die treine werk nie. En as jy by die hawens het, kry hulle uit nie by die hawens werk. So dis 'n bietjie van iets wat commodities is 'n goeie plek om te wees. Banke, hulle is baie dit is goed gebou. Dit is so die scenario wat ek nou geskep het nou. Ja, dit is 'n bietjie skrikkerig vir banke. Maar nywerheidsaandele. Jy gaan nie daar's nie nywerheidsaandele want die goed kan nie werk nie, fabrieke loop. Die verbruiker ook nie meer skoor het. Dit is die goeie wat ek sou kom. Randverskansers, miskien commodities.
Ja, dit is 60-70% van die mark.
Ja.
So dit beteken dat jou opportunity set is maar hoofsaaklik skewed in daai rigting. Maar ja, ek hoor jou punt by die banke, maar jy word ten minste gecompenseer. Terwyl jy wag vir daai sentiment om te draai, jy kry 8% per jaar vir 'n dividendkoers. So
ek dink die mark is as kop aan China. Jy weet ek dink ek kan nogal sê jy kan al die stories en jy kan probeer sin maak van daai sektor. As China in die fire gaan dit omtrent 80% van ons mark affekteer. Die groot rede is want Tencent affekteer Naspers. En dis by ver die grootste baat op die mark. Ons kommoditeite word direk gedryf deur China, 'n van die mark. Dan het jy ouens soos Richemont. Luxe goedere word hulle is verantwoordelik vir 60% van wêreld se luxe goedere verkoop. Dit word deur hulle gedryf. En as jy kyk ouens soos Anheuser wat bier en goeder vervaardig in Europa. Christian het gepraat van die travel syfers. Dis die Chinese wat travel vanaf China in Europa in. Dis ook hoekom die Europeërs op die oomblik, jy weet, jy sien net nog nie daai deurbraak op hulle mark nie. Want die Chinese, hulle mag miskien travel, maar hulle travel Macau, daai plekke toe. Hulle travel nie voluit Europa toe op die oomblik, waar hulle nie spandeer nie.
Jou punt is sentiment, dis China.
Dis altyd gesamentlik, altyd
Sien kommoditeits.
Nee, so as die
Kommoditeits van die China, gaan uit Indië.
So as die sentiment begin verander op die eiendomsmark, dan gaan ouens weer begin eiendom openlik. Dan gaan daai kyk altyd van money supply en die ekonomie gaan weer begin funksioneer. Banke gaan meer krediet begin uitleen, hulle gaan eiendom koop en dit gaan ons ouens, ons mynboumaatskappye, ons kopermaatskappye, ons ystererfmaatskappye gaan dit weer begin stoot. Jy weet, en dan hopelik in daai tyd, soos jy sê, dan is die Transnet issues al 'n bietjie uitgesort en die loadshedding is 'n groot probleem nie. Maar dit kom uit op China.
Ja.
Ek het net iets gesê. Wat ek wou eintlik gaan vra, tot watter mate op watter stadium het ons commodity sake eintlik gekoppel geraak in China se gebied. Want van tevore was dit nie so nie. Dit
Die Chinese infrastruktuurontwikkeling in China het al steeds verstom. En nie net die infrastruktuur, maar ook nog so baie meer gesofistikeerd begin raak, of meer gesofistikeerd waarde. En daarvoor het hulle nie die steenpoeder waar die tipe soos byvoorbeeld platinum of palladium is. China was 'n groot drywer van maar die afgelope tyd by die Chinese ook gedoen het, hulle het oorontwikkel gevaar. Daar's ton olifante wat nog buite het. Maar daai moment op waarskynlik word gedoen deur die Indiërs, soos wat ek praat van op die tyd ons. Daar's net so as ek praat van 'n sterk commodity, dan moet dit nie idee kom. Die Chinese ook so 'n bietjie, maar die Chinese is nie, en dit klaar klein lyk, soos byvoorbeeld dan plek soos Vietnam, Vietnam is ons plek wat kan byna raak, maar as dit is nie vir die volgende super civilisasie staan. Daar's net 'n probleem met dit. Net so 'n issue wat ek het. Dis baie happy met dit. Maar die idee is dat ernstige immigrasie baie ryk mense was verlaat. En dit beteken jy loop dit verraad. Dat die eerste minister so. Op die plek in Europa, dan moet ek 'n president in Amerika ook. So dis ryk mense wat nie verlaat, dit is baie sleg.
Maar jy sien het in die eiendomssektor gebeur in India, jy weet in terme van verstedeliking, waar ons van die plattelande na die stede toe trek. Die probleem is net met India is ek kan sê dit so wat klink ons is 'n tape recorder. Hulle, jy weet daar's 'n baie groot income inequality tussen die noorde en die suide. So om die infrastruktuur, om dit te begin gaan tyd vat. So ek het baie
En lastly,
Net interessant wil sê, dis net so amazing. Daar's verskillende state in India. En ek het nooit besef nie, hulle douaneposte tussen verskillende state. In sommige gevalle maak dit sin, by een staat doen baie kommoditeite verskillend op baie met die douaneposte tussen die lande. Dis nie so bekend as die license rapport.
ons gaan nie nog vra nie, ek dink ons gaan na die nog vra nie. Kom ons kyk dan oor Dian, ek dink julle is nog.
So even more start with presentation on people rights and research switches around Africa portfolio. Even and then we're gonna provide an update on our expansion trade and also what we're planning for next year. And then I'll try to answer Siako's question on what will happen in the next 2 years. So even I'll give it to you.
Yes, I can say this one is the overview of the income portfolio quickly. As he said, we made some changes there, but just a good performance snapshot. So portfolios continue to deliver very strong returns, provide a lot of capital protection against kind of a difficult environment for bonds, as we've heard and we've seen over the past few months. And I specifically showed in investment growth terms, this showing over the past 5 years, the cash, so the static pool deposit, which is the benchmark of the portfolio, as well as the whole bond. Just to highlight that using the spectrum of fixed income instruments, so coming from cash all the way to bonds, as you would know, we prefer that flexible income space. We are able to get some of the yields, some of the capital exposure or capital gains on the bond side, while also picking up the yields from cash instruments that are very high to trading around 50-year highs. And this has resulted in kind of very smooth portfolio performance, almost giving growth equal to that of all bond index, but at a lot lower volatility. So over 1 year, the portfolio's returned 9.35%, so it's just under 2% ahead of the benchmark. Looking at the kind of spectrum I spoke about, so you all know this yield curve we show as well. Starting from cash all the way to bond, increasing with risk as the yield increases. So again, as you know, we prefer that flexible income space where we can make use of the whole spectrum. Flexible incomes are typically ranging around 9.5 to 10% yield at the moment, and Navigate Income is sitting at the top end of that. So if we just look at kind of this for end of August, if you look at our holdings, the way it's structured, we're currently sitting around 11% gross yields forward looking, at a duration of 1.9 at the end of August. Okay, so getting to some of the changes we've made then, and this was implemented at the start of September, so we did manage to miss some of that yield sell-offs we had, the spikes we had at the start of September. So the changes we made was to reduce or remove Correlation Strategic Income Fund. We took there was a 5% allocation, we took that out. We reduced Vision portfolio metrics, which is on more aggressive, longer duration income funds. We reduced them by 2.5% each. We allocated a 10% exposure to Prescient Income Provider. But Prescient Income Provider fund is currently yielding around 10.7%. It's got a duration of 1.5. So if you compare it just to Coronation Strat, for example, very similar portfolio in terms of risk. The only difference is that Prescient focuses more on the corporate and credit side, where Coronation has a bit more diversified and more government exposure than its bond exposure. But Prescient Income, lower volatility, getting to that, has shown low volatility and high consistency of performance. And if we focus just on a snapshot to show that in the risk reward scatter plot, as you can see, Prescient Income Provider in the left upper hand quadrant. This is related to all the multi-asset income funds in the sector, also showing Coronation Strategic Income. So you can see lower volatility, higher returns over the past, this was from since 2021, just because portfolio metrics, it has an inception date on 2021. But over the longer term, it's been a similar case. And also showing the consistency levels in that table. The far right, you can see rolling 1 year consistencies and 3 year consistencies. So Prescient has a lot higher consistency in beating the sector, the multi-asset flexible sector, than Coronation has. It's also got a lower beta, so lower exposure, lower sensitivity to bond market movements, and lower drawdowns. So that's kind of what drives that kind of switch. And then on the more aggressive funds, the visual and portfolio metrics, by reducing that exposure slightly, we just manage the duration risk. So we've taken off a little bit, reduced the capital volatility, reduced that interest rate risk by reducing the portfolio level duration. And as I said, because Prescient Income Provider is more corporate focused and has more credit exposure, we have subsequently obviously been slightly from the duration risk to the credit risk space.
I mean, just to add to the capability, I've got a credit team, I've got 10%, which they can invest in unlisted debt. So they can get a much higher rate than any other flexible income fund manager out there because they issue the debt. It's not like I borrow to a bank. I go out to a market, look at corporates that need money, and they lend it out, and they can get a much better yield on that 10% component. That's a max you can allocate within a unit trust. So it's actually like an alternative private debt fund within a unit trust, which is quite unique and nice. There's not many of them that can actually do it. Prescient has got the capability when it comes to issuing debt. We've got a legal team that's looking after to make sure that they will get their money back from those corporates when they. So that makes them unique. Coronation doesn't do it. They just buy listed debt. They don't issue it, like Prescient is doing it. Very fun.
Thanks, guys. And then maybe also just on the kind of the managing the exposure. So you see that next slide is showing specific portfolio metrics of yields that they're getting in the portfolio at the moment. You'll see on the table as well, the gross yield is currently around 12%. So very attractive, but that comes with a higher duration and it comes with a lot of risk kind of compared to what you typically even see in the space. They are one of the more aggressive funds in the flexible income space. And this just highlights again why we prefer to use that kind of multiple strategy, multi-manager approach, blending the exposures of more aggressive, high conviction, high duration funds with the shorter end, as well as more credit focused funds. So this is focusing on portfolio metrics. So the 12.4% line at the top shows their yield at the moment. And this is just highlighting why we still find this very attractive, why we still have exposure to these funds. We heard a lot about the kind of outlook for bonds, some of the risks that kind of instruments have, especially the government bonds. There's a lot of attractive, a lot of value on offer. If you hold it over the longer term, there's a big buffer built in. We can see that if you look at versus inflation and inflation forecast, portfolio metrics, for example, at 12.4% yield at the moment. If you compare that to the upper end of the inflation band at 6%, we're looking at CPI plus 6% returns at a duration of 4. So technically saying that if you hold that portfolio to duration, so 4-year investment horizon, you should realize that CPI plus 6% returns. So it's very attractive. At the bottom, I just showed the table because there's a lot of questions coming through on the bond side after the big sell-offs and the impact of interest rates. Just showing that how much has been built in, kind of priced into the market. The bottom table shows what would happen to total return over 1 year period for 100 basis points or 1% and a 2% either cut or increase. This is looking at the JIBAR rate, so cash. So what that says is if the JIBAR rate was to reduce by 100 basis points, so if we were to see a 1% cut in the cash rates, your upside for 1 year from this kind of yield level to around 15.8%. And that's equity-like returns that we can expect from these yield levels, from this portfolio. On the downside, if you have a 100% basis points, 1% increase, even a 2% increase, the 1 year expected return is still sitting at 7.25%. And if you compare that to what you get in cash, worst case scenario, it's slightly less than what the repo rate is. So that higher upside versus the downside picture. Right, and then lastly, just quickly on the fixed deposits. Recently, fixed deposit rates have come down significantly. So if you now look at what we can get on Navigate Income, for example, at 10% plus, even over a 5-year fixed deposit nominal rate of 9.4%, arguments obviously doesn't add up. So much more value by allocating something. You have liquidity, don't have tax implications. You have something that gives you inflation protection rather than locking money in for 5 years at a lower yield than what you can get something like 10%.
And clients should always compare nominal rates to our yields that we quote. We don't quote effective yields. So banks like to quote 12.2% over 5 years. We don't quote that 12.24%. We quote the nominal, which is currently 9.59 over 5 years. So clients just need to be careful, compare like for like the yields.
That's it on Navigate Income. Do you want to add anything else? No. Okay. So then we're going to do an update on the multi-strategy hedge fund portfolio. I want to specifically focus on what we're doing, so the research we're focusing on and the portfolio we want to launch. Just starting with a quick performance update again. So as you all know, this portfolio targets consistency. We've got an official benchmark of the high equity sector, so it's a long balanced fund. But we've got an internal benchmark of CPI plus 5 that we want to achieve. In the far right of the table, you see that since then, the portfolio's official track record, which is 2020, that is the date that all the portfolios we use have official RIF data. So it's not based on qualified performance. It's all retail based on current regulations and current mandates. We see that from that period, the portfolio has done very well, this outperforming the sector by close to 2%. And then also adding almost 1%, obviously plus 5, and a lot less volatility than what you would have experienced in the high equity from a balance fund. So doing exactly what we wanted it to do. And this is kind of the focus points to put in perspective what we want out of this, out of this portfolio. So on the left, I've shown the average drawdowns of the portfolio versus the high equity sector and the all-share market. So as you see, from 2020, the portfolios had an average drawdown of 1.9%. So meaning any peak to trough drop in capital over that period, average has been 1.9%. But that compares to that of the sector around 5.5% and that of the all-share market around 10.5%. So a lot of protection on the downside. In the middle, we then show the down capture return. So this is specifically focusing on the actual performance that the portfolio delivered in times when the markets were down. Seeing that it's positive, so portfolio typically was delivers 0.2% return, but the all-share market in the high equity sector is down. Okay, so complete no sensitivity to the market, no sensitivity, but very little sensitivity to the market. So able to deliver positive returns typically in down markets. And then on the upside, just to show that it also captures a lot of the upside, so still participating in delivering positive returns when the market is positive. And that's what results in this picture of lower volatility, but increased returns or higher returns. So in that left-hand quadrant. Most of you will have seen this picture before, just versus peer group, a lot higher return than large movers. Okay, so let's focus on what we are doing. So we've spoken about the more aggressive version of the portfolio. We work on it. Big limitations, availability of funds across the platforms, and also getting the data that's actually reliable. So we've identified 4 managers, T3, Orium, Steyn Capital, and Amplify, which the underlying manager for the Amplify fund being Western. We are going to focus on for due diligence as we're organising, we're going to have them in November. They are kind of our first to pick for the more aggressive version of our hedge fund portfolio. So you'll see that most of these portfolios are long short equity. There's 2 forms of entry. The one is a multi-strategy. The Orium fund is a market neutral fund focused on equity. And then Steyn Capital, they're just a long short equity house. Sorry, portfolio, but they're very focused on the short side. So that fund typically holds more than up to 40% on its book in short positions. That results in a lot lower correlation than the typical long short equity fund. So it's quite a strategy than the Amplify ECI managed fund. Now, there's a bit of a limitation when we look at these funds, or just some risks and considerations. I'll say firstly, the data availability, because most of these portfolios have very short track records as retail funds. When you're doing backtesting, looking at the returns, it looks amazing. Wildspring, for example, from February, average around 30% per year for the last 2 years. That's all based on qualified investor limits. So they can take a lot more gearing, they take a lot more aggressive positions, and they don't have to adhere to the daily liquidity and pricing of the instruments. So using that in back testing and allocating it to portfolio, there's a lot of risk going forward to what we can expect within the risk mandates. So due diligence is focusing on that type of information, so making sure that we can trust the qualified track records that we implemented in a risk portfolio. So that's one of the things. And obviously, when we're looking at a more aggressive version, we should know that we're going to be increasing the volatility of the portfolio, looking at higher drawdowns potentially, so higher capital risk, and a higher correlation with the general market. Because these are more long-term equity funds, we naturally have a higher correlation to the market. The exception of that being the Steyn Capital Fund, as you can see on the table, I've shown correlation with all-share only at 0.2, so very low correlation. And then the market neutral fund, which you would expect, which aims to have 0 beta, would have a low correlation as well. But in general, they're going to be more aggressive, so they'll have a higher correlation to the general equity markets, and then a higher fees consideration as well. Typically, these funds, aside from normal performance fee participate in, some of these funds also still charge 2% management. So that has a really capital implication when we start adding it to other portfolios. And here I'm just showing the kind of again, so snapshot. This scatter plot, easiest way to see the kind of profile. On having a multi-strategy hedge fund portfolio, again focused on consistency above the high equity sector. So on the left, above the high equity sector, looking at these more aggressive funds and long-term equity focused funds, we're shifting into another area of the spectrum. So much more volatility, higher volatility than the all-share market. From the underlyings, also high returns. So we are aiming to launch this portfolio in January. So as I said, we'll be conducting due diligence meetings down through November. to keep you updated with the portfolio.
I just go back to the performance. So remember, despite that 5% TIC, so it looks extremely high in the quotes, but this performance is after that 5% TIC of portfolios. And there's still these managers consistently outperform balance funds or CPI plus 5%. Gives you consistent returns. So my idea is that this portfolio can be used in your medium-term side, it's between 2 to 5 years long. And then your long-term side, you can use this new portfolio that we launched. But this is really a very nice solution in times like now where it's very uncertain. Clients are concerned about the economy, about the stock market. If these managers can generate returns irrespective of market performance, look at last year, you can see balance funds went down last year. Most funds still delivered positive returns despite the market going down. So it's a very nice solution to add to your client's portfolio. We keep it separate because it's got a 5% TIC. You need to have a license to sell hedge funds. So we keep it separate because we think it needs a separate discussion with the client to explain what is hedge funds, how does it fit in your portfolio. But I think there's definitely a spot for these portfolios in the portfolio, 10% in a retirement product and up to 20% in the living. It gives you nice, consistent returns, less volatility. You don't have to explain too much negative market performance. Last month, even it did minus 0.8. But markets were down up to like 4%, 5%. International were down 6%. So now in September, we're like all asset classes were negative. Bonds, property, equity. This portfolio was still flat, despite all asset classes giving you minus 2.5 to minus 6% for September. So a very nice solution to provide in the client's portfolio. Any questions on hedge funds?
Yes.
Just it would be nice if we do with what your credit said, we do want to blend it with like RA savings or anything else. It would be nice to have the team to be able to obviously monitor that 10%, be able to keep it in check. First, obviously, us doing it alone at the office. Is that something you guys would maybe look at some point? So, because obviously you're doing it sort of now, internally you're doing it, you say you don't care, pushing too much more frequency, bringing it back, you're doing that right now. Would it mean that we do start bringing these some portfolios into the bigger sort of full portfolio, all of them, it would be nice for us to be balanced overall. That would just so it'll take a bit of admin from the
So the technology of the platform is far getting better, but it's still behind. If you look at the global markets, our portfolio capability is much better. Globally, it's much easier to do the portfolio like you see the combination of a balanced portfolio and hedge funds. But currently in South Africa, our platform is a bit behind. It comes from our portfolio tech. So at the moment, it's not possible, but we're looking into it and see how we can implement it. So give it about a year, and we should be able to do it. But currently, not.
If it was included, for example, in having a balance in the structure, that we would be able to manage that on a daily basis. But because of the fee argument,
You've got a year to rebalance it. So if you're a client once a year, the client will remain regulated compliant if you see that client once a year. You don't have to do it every day, every month. Once a year is far from a regulated.
En dan net op 'n praktiese punt, né? As jy die portefeulje gaan hy ook soos op jou maatskappye onder die portefeulje categories gegroepeer word. As jy nou byvoorbeeld 91 ingaan en ek doen 'n RA en ek kies, dan kan ek kies model portfolio funds. So as ek model portfolios kies, dan maak al die Naviga model portfolios oop en ek kies Naviga balance. En
I ook al, ja. So when you select 90% Naviga balance, for example, 10% this portfolio. If you don't see it, please contact us. Firstly, we need a license for hedge funds. And secondly, we need to open those portfolios up. You can access at the platforms because the platforms, they don't want to open it up in bulk. They just want to make sure you've got the license, you've got it and don't see it. Please let us know. It takes about a day and then you've got access to those more portfolios. Yeah, let me go on this slide more. I think, maybe start with Jaco's question. There's so many concerns in the market. This just goes back to 2011, but every year there's a reason not to be invested. Every day there's Europe, the US fiscal cliff, there was China, there were COVID-19, Russia invasion of Ukraine, now Israel, we've got higher interest rates, higher inflation, but every year there's a reason not to be invested. But despite that, if you look at it in the long term, if you take more risk, you'll get a higher return. No, unfortunately, no fund manager can exactly tell you what's going to happen in the next 18 months. I can guarantee you they will be wrong in their forecast for 18 months. No one will be able to tell you. But if you invest for 5 years, I know it's difficult to keep clients invested. But if you look at valuations, if you just invest today, go away, 5 years later, you should make a lot of money. If you look at the big managers like Allen Ray Coronation, 91, all of them is close to maximum equity exposure. Because they say it's so attractive valuations, not only locally but globally. There's so many opportunities. So I'll give you maybe a couple of suggestions what we can do to keep clients invested for 5 years. But if you close your eyes 5 years later, you should be having your investment portfolio. But we have to feel it good. Yeah. But no one can answer this for you. So like I said, there's always a reason not to invest, but we know, and I'll get into tax as well, despite getting a better return from equities, you also pay a lot less tax. And hopefully you can use tax to keep clients invested in the market. Okay, so yeah, this is a strategy, maybe one of the strategies. This is for before retirement. So it's not post-retirement, before retirement. Let's take an ultra-conservative client. And this client said, I don't want to lose capital over 5 years. What you can do is invest 62% in the income fund and 38% in the equity fund. So that 62% will earn 10% per annum, like Ian showed. And after 5 years, your capital will be 100%. So if actually your portfolio or equity portfolio goes down to zero, which is unlikely, you still get your capital back because that 62% will grow over time to 100%. You take no risk, got a capital guarantee, it costs you a lot less money than a structured product, better diversification, you don't take credit risk, it's well diversified. So a very safe option for clients who don't want to take any risk. The other 38% you have to invest in equities, property, in growth assets that can generate a return. As you can tell the client, even if that equity component goes down to zero, your capital is still guaranteed after 5 years. So this is maybe a suggestion. If this is how structured products work, they use a portion of your capital, invest in a bond, that bond will mature at 100 rand, and they use balance to invest in options in the market. But with an option, you don't own anything. You own a guarantee from a bank. That bank defaults, you lose all your capital. You don't own any stocks. At least with an equity fund or share portfolio, you actually own the stocks. And those stocks shouldn't go down to zero. Because then we've got bigger problems if a stock market goes to zero. So this is maybe an idea for very conservative clients. This is an ideal asset allocation. 62% income funds, 38% equities for very conservative clients. So post-retirement, you all know the silent approach, but what I want to focus on is what value does it add over time. So I used the scenario like last year when markets fell by 20%, then recovered. In this scenario, equity delivered, what was it, 12%, cash did 6%. But in that year, equity lost 20%. So what is the alpha that this approach adds in the client's portfolio? The bottom line is the income need, so 5, 10, 15% income need. And to your left is the portfolio's low, medium, high equity. So let's take a client in a balanced portfolio, high equity, take a 5% income. That additional alpha to the client is 0.27%. As the client's income need increases over time, we see at 10%, 0.85 per annum, extreme case 15%, 1.46. Obviously, with a low volatility portfolio, not much alpha added. But most of our clients are either like a medium equity portfolio, drawing between 5 to 10%. So we add about alpha of 0.1% to 0.85% per annum just by using the silent approach. This you won't see on a faction. So this is not the performance on a faction. This is by using the bucket approach or the silent approach instead of giving a balanced portfolio to a client in a volatile market. Secondly, we rebalance portfolios. For periods in time, markets did go up, but it didn't deliver fantastic returns over this period. But after COVID, as markets went up, almost every 6 months, we took that profit back into income. The most recent one was in April of this year. Markets still went up after that, but then markets came down and we're at the same level than about April of this year. But now at least we can tell clients there's still about 2.5 years of income left on that short-term side. Don't panic for September. You can see September was quite drastic. Global equities were down 6% in rands. Local equities down 2.5%. But clients don't panic. We did take profit in April. There's sufficient income for the next 2.5 years. So don't worry about the markets. Give your long-term silo enough time to recover. So we've seen that over years, this silo approach has been very effective because you can explain to the client there's always a component that's safe for your income. Don't panic if markets fall. There's always a short-term silo that provides stability and your income on a monthly basis. And when markets recover, we'll take some profit, put that profit back into the short-term silo, and always ensure that there is enough income in that short-term silo. So this also helps to change the behavior of clients. Let's say, doesn't matter whatever short-term happens, there's always a safe component, don't panic, stay invested for market. And then a last option is tax. So hopefully we can convince clients from a tax point of view, then go into more conservative portfolio. So let's start, how much cash can you have before you start to pay tax? For client below 65, you can invest up to 280 per annum. Client above 65, you can invest up to 405,000 in cash without paying tax. So this is ideal for emergency fund, but anything above that, clients should invest in the market. So just for assumptions quickly, I created a balance portfolio, looked at the possible capital gains, what's the yield of that portfolio, how much dividends, because I needed that in the calculation to calculate the tax for the client. So to compare it to a money market fund, before tax, there's about, not much, but about 3.5% per annum difference between a balance fund and a money market fund. But after tax, there's quite a significant gap between the two. That goes up almost to, what's that, quickly, 5.6. So before tax, 3.5% clients will say, oh, but 3.5% is not much, but you need to consider tax. And after tax, that gap grows to 5.6% because now it becomes, if you work it out over 5 years before tax, only 17% more capital of a balanced portfolio versus cash. But if you consider tax, that goes to 30%. You're going to have 30% more capital after 5 years. So after 10 years, that will go up to 70%, and so it goes on and on. So 30% is quite significant over 5 years, but for most clients, we're paying for much longer than 5 years. But if you can't convince clients to stay invested in the equities, at least consider a sinking fund down. Because if you look at the red line, that's a straight money market fund, you're going to lose capital after inflation. Yellow line, money market endowment, at least your capital will remain the same after tax, but ideally clients should be in the income fund because at least your capital will grow after inflation. Not much, but at least it will be positive in a sinking fund. So consider for clients that don't need the income, consider a sinking fund if they don't want for flexible income fund. Another reason why to consider a flexible income fund is the tax benefit. So I had a look at Select Manager Income Fund. We managed it exactly the same as Navigate Income Portfolio. If you look at the last 5 years, only 90% of the return was taxable. Component was capital in nature. But more recently, with the portfolio changes we've done, that has reduced down to 75%. Because of the credit funds we've selected, those credit funds, a big component is capital in nature and not income in nature. And secondly, from bonds, many of our bonds is currently trading at a discount. And that discount will eventually disappear over time, so there will be some capital gains from bonds as well. So flexible income funds is much more tax efficient than a money market fund. Here's an example of one of the bonds. Not all bonds are trading at a discount. But R209 is trading at 61 Rand. That needs to mature at 100. So there's a capital gain of 39 Rand in that bond. This bond was only issued at a coupon of 6.25%. So clients that invested initially only received 6.25% interest per annum. These days, the government needs to pay 12.5%. This shows the impact of our fiscal debt problem. We used to pay only 6% on our debt. Now we pay more than double it. That's why we are in trouble with our budgets. But to get back to the point is that coupon rate of 6.25% is an interest rate of 10.25 on the capital. So we took that 6.25 coupon divided by the 61 rand, get an interest rate of 10.25%. But we quote for bonds as a 12.5% interest. So that difference between the 12.4 that we quote and the actual interest clients are receiving at 10.25 is capital donation. So only about 82% of a bond return will be interest price and not, and the rest, 18% will be capital donation. So that's why I say these bonds need to mature at 100 Rand in 13 years' time. So there will be some capital effect as well. So that's why flexible income funds are more tax efficient because a portion is credited, other portion is explained by bonds, but just needs to mature at 100 Rand, and that's also capital donation. So I think we'll stay roughly at about 75%. We don't foresee it to go much lower. So let's say 75% of the return will actually be taxable. So compared to money market funds, an income fund needs to only deliver 7% versus 8.5% of money market, because after tax it will be exactly the same. So even if flexible income funds underperform money market by 1.5% per annum, you're still going to get the same return after tax. We expect about 10% return. So the clients can expect about a 2% outperformance versus money market. That makes sense. Because obviously there's always concern about flexible income funds. September, flexible income funds were negative. Now clients ask, okay, shouldn't I go to money market? But at least we can tell or show to clients now that even if flexible income funds underperform by 1.5% versus money market, you're still going to be at the same level after tax compared to money market. Like Eben showed that the income funds actually outperform money market by 1.5% or 2%. But this is maybe a different way of showing to clients, don't go to the bank, don't go to the money market or fixed deposit, because we can provide personally a high yield at 10%. And secondly, it's more tax efficient. You don't pay 100% tax on that interest. And when I'm busy with a calculator, so to illustrate to clients, okay, but how much additional tax will you pay if you decide to move out of a balanced portfolio into money market? And maybe vice versa as well. Maybe you could show to the client, you're currently in money market. If you go into a multi-asset low, medium, or high yield portfolio, how much tax will you save? Because I think for a couple of years, clients didn't pay tax on the interest component because money markets were only at 4%. Now money markets are 8.5%. So they're earning more than double their interest than 2 years ago. Now suddenly, with the tax season, clients realize they actually need to pay tax on the interest. So maybe you can use fiscal to motivate clients to go out of cash for money market, either into a flexible income fund, low equity, medium, or high equity portfolio, because they're going to save on tax. So we'll distribute this KI calculator soon. I just need to finalize it and make it a bit more pretty and so on. But I think it might be a useful tool to motivate clients to stay invested or get them out of cash into a multi-asset portfolio. While we're on the tax, I don't want to go through all the Navigator Porsche slides, but maybe just to focus on this cash component. So we touched on the local side. With the global side, we only use accumulating fund classes in all our portfolios. The clients don't pay any tax on their interest, but only pay capital gains tax where they sell those units one day. Currently, we're sitting at 51% cash at the moment. You can see much higher than the peer group. Peer group is only at 10%. We're very conservative because you get 5% yield in dollars on that 51%, which is quite a decent yield without taking any risk. But that 5% is not taxable, yet that full 5%. Versus a client that's in dollar cash, maybe that's investing, they're going to pay full tax on that interest payment. So a much more tax efficient way of investing clients' conservative money offshore is to go into a life wrapper and use accumulating fund classes and not income fund classes. Then lastly, on performance. Performance has been good. The income portfolio top quartile over 1 year, despite slightly lower returns in September or negative returns. This portfolio still delivered 9.3% versus 7.5% for money market funds. Looking forward, it should be higher because now money market is at 8.5% instead of 7.5%. So that 9.3% should be at the 10% that we indicated earlier. Navigator cautious, first quartile, but still outperform the average, 10.65% versus 10.46%. So still outperform the average, but first quartile. And the balanced funds, much better return. It's a good time now to go back to clients to do a review, because if you wait until October, those returns will be below 10%. So use this opportunity to provide feedback to clients, 13% over last year. But in October, if you measure over 1 year, it's going to be probably below 10%. So try to do all your now. I mean, I got flexible, nicely recovered. I know there were some concerns about I got flexible a couple of years ago, but in the last year, that's 15% versus the average balance fund of 13% versus the category of only 12%. So it delivered balance funds plus 2% in the last year. But just remember, flexibles, high risk, actually 28. And last year was a good year in the market. So obviously that portfolio will do better if markets recover. Navigator growth of the short term, slightly lagging a peer group. Ford Flexible underperformed and some other flexible in worldwide funds underperformed. But over 3 and 5 years still better than average. Equity performed well. And then global equity performed very well, but that was mostly due to the rand. So 24% up in the rands during last year, but don't expect the same return out of global equities in rands next year. Global, all portfolios with top quartile better than average. This is all in rands, in dollars, much lower. Maybe just to highlight is that the cautious and balanced portfolio delivered very low returns over the last 5 years. But clients should remember, cash were at zero, bonds were at negative. For the first time, we've got some decent deals in cash and bonds globally. So the global cautious and balanced portfolio should deliver much better returns for the next 5 years, because now you're at 5%. If you get some decent equity returns, you should get much better than 5%. But during the last 5 years, cautious funds delivered like 2%, balanced funds 4% in dollars. But like I said, now it should be 5% plus. And then our post-retirement solution, also top quartile, above average over 1, 3, and 5 years. Plus, like I showed, there's additional alpha when you use the silent approach compared to advanced. But that we can't show yet. That's at client level, because each client's income level is different. They start at different times. So you'll only see that alpha in the internal rate of return for each client. Unfortunately, we can't measure it yet. This is that system. We are able to show to clients, this is the alpha we've generated from the fund selection, but there's also an alpha from the silent approach compared to just selecting the balance. So it's been a good year in all the portfolios in absolute terms. So good returns above 10%. Like a post-retirement portfolios, 11, 13, 13, almost 14%. So it's been a good year. But we expect returns to come a bit lower. But if you stay in this for 5 years, if you look at the 5 years, returns are extremely low at 7%, 7.5, 7.3%. So that number should be much better over the next 5 years. You stay invested. Clients should also just remember inflation cash were much lower during the last 5 years than compared to what we're going to expect for the next 5 years. Cash is now at 8.5%, so returns should be much closer to that 9% that we proposals to clients. And that's it. So I don't have an exact answer for Jaco for what's going to happen in the market, but hopefully we can convince clients from a tax point of view not to panic. the silent approach multi-planning, or using that other structure of 60%, 62% income funds, 28% equities, and clients should be happy in 5 years' time. But unfortunately, I don't know what else to say, but I think there is some solutions available to keep clients invested, try to manage the arrangements. I know it's not an easy job.